Thank you, everybody, for being here for this insightful panel in relation to ESG and crypto. We all know that ESG has become one of the most important factors when it comes to investment due diligence, specifically in the traditional markets. And its application to crypto is still very nascent. We've seen it being used as a deterrent in a lot of ways to highlight the electricity consumption of Bitcoin, for example. And a lot of work does need to be done in that area, but I think it's also important to highlight some of the many benefits in terms of ESG that cryptocurrencies can provide, including the social and governance elements as well. And what we've actually seen in comparing assets such as Bitcoin to maybe the rest of the asset universe, especially since the merge of Ethereum moving to proof of stake, I think we've seen a lot of attention on the ESG factors that are prevailing within crypto. So with that short introduction, I'd like to pass over to my panelists just to give a quick round of introductions.
Thanks. So I'm Lena Klaaßen. I'm one of the co-founder of CCRI, Cryptocurrency Ratings Institute. Me and my co-founders have been researching in the field for already quite a while. So we started in academia, published quite a bit of work on the climate impacts of cryptocurrencies. And then 2 years ago, we founded CCRI to make our research and our data also available to the crypto industry and to help bringing more transparency in the field. So really looking forward to the discussion.
Thanks, Lena. Yes, I'm Nick Jones. I'm the CEO, co-founder at Zumo. I'll probably just stick to the sustainability relevancy of what we do. We are a crypto infrastructure business at heart, but about 2 years ago, we started on a net zero journey, which ended up, or the first stages ended up this summer launching a product, Zumo Oxygen, which allows any institution who holds Bitcoin or other cryptocurrencies on the balance sheet to assess what their electricity impact is, and then to buy renewable energy certificates against that usage to mitigate the electricity that they use and their kind of carbon debt, and then to be able to disclose that in the same way as they would make any other kind of ESG disclosure. It's going extremely well, as you'd imagine, particularly with larger institutions who want to align their broader kind of ESG strategies and disclosures as they're moving into the digital asset space. They want to make sure that the two things are together, and that kind of theme of convergence is one of the big ones I see for today. But yeah, delighted to be here.
Thanks, Nick. So I'm Thomas Kettner. I'm the CEO of MarketVector Indexes. We're an indexer in the fixed income, equity, and crypto world with around $30 billion in assets under management, and we started our crypto business in 2017.
Thank you so much. I think what I'd like to do to kick us off and maybe set the scene for our audience is ask a group question. So I'd like to understand from your perspectives, how do you define ESG within digital assets, and what characteristics of crypto do you think align themselves fundamentally with the principles of ESG?
So to define things here, I think it's quite helpful to look how ESG in digital assets compares to ESG in the corporate world. So one important difference here is when you look at digital assets, you look at the impact of a project, while in the corporate world, you obviously look at companies. So this is one of the main differences that should be kept in mind, but there are also lots of similarities. So for example, the difficulties in getting the right data and the importance of quantifying them and having aspects and dimensions that are really useful to quantify the E, the S, and the G part. And then parts of inherent characteristics of cryptocurrencies. So I do not necessarily think that digital assets are inherently superior in terms of ESG. But what they do, they offer inherent characteristics, so to say, to make them really good measurable in terms of ESG data. So for example, what we also do at CCRI, that we set up nodes in the network to really measure the electricity consumption on a comparable set of hardware. And we can then also use on-chain data to model the carbon footprint of the network by looking at node counts, transaction counts on a daily basis. And these are just assets that you do not have in a company that does not disclose on a daily basis their data to the public. So this is something what makes digital assets really inherently useful to look at the E, the S, and the G part of it.
Yeah, that's a great kind of jumping off point for us, and we're actually partnering with CCRI on using their data for our calculations with our customers. Yeah, that transparency piece I think is probably one of the key USPs, if you like, for the sector, both in terms of, well, how do you decarbonize or how do you mitigate the digital assets that you're holding as an institution or as an organization, but also as we move into digital assets being applied to the underlying kind of carbon marketplaces, which are in severe need of, one, modernization, and two, much greater transparency, because there's some fairly big issues which have come up over the last 18 months or so in those carbon markets around double selling, around the validity of the underlying projects, around actual worth, and there's obviously been some fairly high profile examples of companies probably trying to do the right thing and ending up in a kind of greenwashing space. So I think there's probably two dimensions to look at it. One is, I believe that blockchain-based digital assets are uniquely transparent, and they have a kind of discrete set of energy use, which lends itself very well to analysis and ultimately towards moving towards decarbonisation. And secondly, the underlying protocol from an E in the ESG point of view can really help revolutionise, provide clarity, provide trust into some of these marketplaces where we know we've got some issues. I think on the broader levels, it's interesting if you kind of look at it through the S and the G element, which probably doesn't get talked about quite as much. From a governance perspective, obviously the decentralized dream is that this would be a kind of self-governing ecosystem. But the reality is due to some of the challenges we have with kind of full decentralization from an actual functionality and usability point of view, we're at this place where institutions are holding very large amounts of crypto in a relatively centralized way. And, we've seen, obviously, over the last 18 months, a very, very strong need for governance, regulation coming into the space, driving this forward, allied to the kind of social factors that are moving things forward. What I would say, again, and back to my earlier point, is just this convergence. We're seeing this convergence of governance, of an acknowledgement of a need for sustainability, of the social aspect of businesses that are operating in the space. And I guess what we should aspire to do as a new industry is kind of have this leapfrog effect, so that we're not just aspiring to the standards that kind of traditional finance has, that we're kind of aspiring for more, that we should be trying to set that gold standard.
Yeah, I mainly agree. I think ESG is currently the most common concept to measure sustainability, what you mentioned. I mean, there are others as well, but this is the one investors ask for. And and compared to traditional asset classes, it's pretty new in crypto. So on an index side, we're currently looking into the data and checking what we could do with these data.
I think that's a really insightful point. And when we consider maybe the elements or properties of ESG within crypto, we've actually seen MarketVector has been leading the effort in championing institutional flows within crypto, but also actually having experience quite extensively on ESG within equity investing. And so I think it does bring a lot of benefits to the ecosystem in relation to crypto. So I'm just wondering what you feel those benefits might be.
So I think there is a micro level and a macro level. So on the micro level, it makes a lot of sense to make ESG measurable and comparable. So that's the first one. We assign a score to a certain project, and the score can also be compared with the score of other projects. And we can also even say, hey, this is 5 points better than the other one, or this is 5 points worse than the other one. So worse might also be interesting for investors, because if you don't believe in ESG, you might think, okay, the bad projects are undervalued because everybody puts his money into the good coins. So that's a different approach. On the macro level, I think it's just a standard in asset classes to have an ESG score. So this makes crypto competitive versus other asset classes. Also, if there is a regulation coming. I mean, we have the European benchmark regulation and the SFDR for the traditional assets. Let's see what MiCA brings for crypto, but probably if you want to put an ESG stamp onto a crypto product, you will also have to follow certain rules. So scoring will help there a lot. And of course, probably the most important is the interest in the asset class, right? If you put an ESG stamp onto something, that will automatically will automatically attract people that want to invest in sustainable projects and help them to find the correct products to invest in.
You mentioned the competitiveness with traditional asset classes, and I think it's almost a given that an ESG classification or principles should be applied to the industry in order to access those institutional flows. Now, Nick, I know that you've been directly involved in the decarbonisation of the Jacobi spot ETF for Bitcoin. And based off of your conversations or experiences, how do you feel ESG might work in terms of converging traditional finance with crypto and enhancing that accessibility to these investment products?
Yeah, I mean, we spent the week at the CIBOS conference in Toronto the week before last. There's a global banking conference there, and it was fascinating. Kind of a year later from where we were, I think one is probably out with the UK, but certainly, you know, we met 10 plus tier one global banks who are in the verge of kind of launching their institutional crypto custody solution, which they'll then broaden out to a broader digital assets piece. So leveraging their balance sheet and leveraging the other advantages they have as kind of a very large established financial institution. I think for them, like the final frontier from a kind of a board sign-off point of view and an investor and a shareholder perspective is how do you square the circle when everybody's reading about Bitcoin using more energy than X, insert whatever number you want to there. How does that play off with, you know, a 15-year green investment or ESG strategy that the bank's been involved in, and how do they move the two things how do they put them together? So I'd say incredibly strong on this growing institutional interest in the space and using the technology, and probably, you know, sort of ticking through the boxes of reasons not to do it. Probably, you know, not quite last on the list, but certainly one of the elephants in the room is still, you know, primarily kind of Bitcoin energy use, and that's still that transference. And there was a great point on the last panel about lack of executive education that's happened in the space, and that's something that's really kind of only just happening now. I would say that people are understanding there's a difference between Bitcoin and other types of digital assets, that other blockchains use fractions of electricity, et cetera, but at a core, it is how do you present that in a way which those institutions, and I actually believe ultimately, you know, a big chunk, probably 35% of retail customers as well, where it's a massively important buying factor. So, you know, I'd like to do this. I like the idea of it. I understand the reasons why I should get into it, but I've still got this kind of red flag against it, which is, you know, these kind of legitimate concerns, or, you know, or because of the kind of the not being able to see the wood for the trees around how much energy does this use? How bad is it? And so I think, you know, addressing that kind of elephant in the room as an industry and trying to provide some solutions is massively important. I think the other thing is obviously not to, you know, not to overclaim or to claim that the solution that you've built is the panacea and it's going to kind of cure everything. You know, very interesting, you know, working with the guys at Jacobi on helping them achieve this Article 8 status for their fund, which is pretty cool. You know, but it's a balance, right? We're mitigating the electricity that they use from the Bitcoin that's being held on the balance sheet and the transactions they have, right? That is a brilliant start, but it's kind of, you know, again, it's not kind of the panacea, but it's about making sure it lines up. Are we greenhouse gas protocol compliant? You know, is there a strategy behind where these renewable energy certificates are being bought? Are we sure that the projects are real? Are we sure they're only being sold once? You know, are we tokenizing them, putting them on chain, which we do to make sure that it's transparent and auditable? So all of these things, and about just understanding that it's kind of part of that. It's part of that journey. It's not the kind of the only answer. And I think that's why, you know, situations like this are super interesting, because you need this kind of you're going to need lots of collaborations and lots of consensus, and you're starting to see that kind of across the industry, people coming together to address these issues. But the lesson from Cybos is that this is, it's one of the last, I wouldn't say a blocker, but it's definitely one of those. It's one of those things which is getting caught in the board. How does the global climate risk team look at suddenly holding loads of Bitcoin on the balance sheet when they're reading contrasting white papers, one of which says that don't worry about electricity, the other one saying that it's using more electricity than South America put together. And I think that helping provide clarity, transparency, as Lena was saying, and a kind of realistic what we're doing and an assessment of impact is the key. And look, strides are being made. We were amazed in a year. Next year will be full of banks launching institutional crypto custody, and will be full of big ETFs being launched. But this piece is like, as I say, it's almost like the missing link.
I completely agree. I think there is a real importance to driving these initiatives and highlighting what work still needs to be done on ESG, but potentially also highlighting the many benefits that crypto projects might provide in terms of ESG. And Lena, I know you've worked extensively on looking at the data, specifically the environmental elements. And one thing I'm sure you've noticed is the huge lack of data availability that exists. There's a clear fragmentation of how to source this data, of how to harmonize this data. So I'm just wondering, from your experience, where do you think those holes might lie in the data availability, and how do you feel we can address them as an industry?
Yeah, so this is certainly a huge topic, but at the same time, there has been more and more movement towards more disclosure on sustainability aspects, ESG aspects. But what we see when we look at these initiatives, that they still vary greatly in terms of their scope, in terms of the terminology, or also in terms of the transparency in the methodology behind it. And this was also one key motivation to set up CCRI, to have this standardized data set that covers more than 25 assets. And we measure this in a standardized way, in a standardized environment, to really ensure this comparability. And this also speaks to the ESG rating that we have jointly built with CCData, to have there a universe of 40 assets that are looked at in the same way. How the industry could improve on these aspects is, in my opinion, to really also look what is already there in terms of standards. So we already mentioned the greenhouse gas protocol, for example. So really aligning the terminology, for example, what is scope 1, 2, and 3 with existing frameworks that also people outside of the crypto world can understand and know what it's about and really be compliant with them. I think that will certainly help. And this also speaks towards, for example, when wanting to make claims on renewable energy usage and reporting in a market-based approach, so to say. So accounting for renewable energy certificates, accounting for power purchase agreement, then to comply this concept really in a consistent way and not cherry picking when it fits and omitting when it doesn't. And stepping up to standards that have already been established in other industries, I think could really help to address data gaps and also move more towards the attention of people that haven't been maybe involved in digital asset space so much before, and feel comfortable with the data that is presented, and also show a certain level of credibility there.
Yeah, I totally agree. I think ultimately, as an industry, there is clearly a lot more work to be done in addressing the data availability issue, and that's something that we are at CCData also trying to push forward and try and enhance that transparency and ensure that we are focusing on this as a clear issue. Thomas, I'd like to go to you and ask you a question. I know that you have a lot of experience in terms of indexing ESG within traditional markets, but I'm quite curious, based on the comments made by Lena in terms of the data availability issues and so on, how do you feel the differences exist between indexing ESG within crypto versus traditional markets? And do you believe those will likely converge over time?
Okay, so as Lena already mentioned in the beginning, it's different if you look at companies or if you look at crypto projects. So at companies, first of all, you probably get an annual ESG report, right? So there is a management There is an auditor to issue that. Also, the ESG efforts of companies depend on the management, or the management can set up the frameworks. And of course, there are other stakeholders, whatever, could be clients, could be shareholders, whatever. In crypto, it's more the community. So again, we have a decentralization in crypto. And also the activities are, of course, different, right? So typical things that we look into for companies are, is the company involved in tobacco? Is it involved in controversial weapons? Stuff like that, right? How many women are in the board? So try to do that for Bitcoin. You you will run into issues. So the questions are different that you have towards a crypto ESG classification. But Lena already talked about that. So regarding building the indexes, I mean, the intent is the same, right? Both in equity, fixed income, or in crypto indexes, right? You want projects that are in line with certain values. So I think what we do for all asset classes is that we define a universe. So in this case, this could, for example, be the universe of projects that have a certain score by CCData and CCRI. In the next step, we would define how we select a project. So it could be a high ESG score, but we can also play around with the ESG data, right? Give a higher weight to E, give a lower weight to S and G, or the other way around. So that's currently a big discussion, because I think in the crypto community, the discussion is a lot about governance, while in the outside world, and then in the papers, you always read about Bitcoin emissions. So it really depends who the client is for this index as well. And then the last part, it's about how to weight the components of the index. So you could go by market cap. You can also involve the ESG scores. So really as you want. And probably the more you involve the ESG scores, the more exposure to ESG you have, but the more differs the weighting scheme from a standard index, which is usually like equally weighted or market cap weighted. So the performance also differs. After looking into some performances, it's currently difficult for us to say if ESG really brings a long-term outperformance, because there is not much data yet to check that. So in equity, you have ESG indexes since 20 years or so. And here we have data since maybe 1 year or 2 years. So we are not able to compare yet, but that will also come. And I mean, that's also probably what ESG investors expect, right? So if you invest in more sustainable coins, then they would outperform in the long run. And they would also use ESG data as a risk control because, for example, companies or projects like Lena last year or FTX would get a low score regarding governance and maybe not be selected to an index. So you wouldn't get a bad performance based on these dead projects.
I think it's interesting to consider the financial performance. I guess, at least theoretically, what you might expect when you're focusing, I guess, specifically on the S and the G functions is that crypto is inherently social and governance is decentralized. I think those tenets are quite different to what we might find in traditional markets. So theoretically speaking, what you might see is the health of projects or protocols, the sustainability of them in the long term will be directly impacted by some of the metrics that might be included in the S and the G. And of course, we don't have much data, and this is an issue for the industry and something we'd like to improve upon moving forwards. But I think just on the face of it, it does seem like a compelling case to at least consider investing in ESG-related assets within crypto. I think you've also touched on, we've touched on some points within the panel, especially relating to sort of overclaiming, greenwashing. These are issues that we see incredibly pertinent within ESG investing within traditional markets. And I think one of the promises that cryptocurrency offers is the transparency of the blockchain and the technology that underpins our asset class. So I think maybe considering these factors, Nick, how do you see the inherent innovations of the crypto market in playing a role in reducing some of those issues we see in greenwashing in traditional markets?
Yeah, I mean, I think there's a few different answers to that question. Maybe start with with carbon credits as an area with sort of under particular stress at the moment, and there's some obvious kind of factors around tokenization, smart contract data built into those tokens, veracity of the projects, both from a kind of a retirables point of view initially, so they can be used for offsetting in a kind of non-greenwashing way, and then ultimately down the line in towards kind of a kind of more robust tradable kind of carbon marketplace, which is the kind of, I would say that's the kind of +1 on the back of getting the offsetting piece right. The inherent nature of tokenization and turning those into digital assets, and the transparency that should provide is kind of like the holy grail. There's a number of great projects trying to address that at the moment. I'd say it's very, very early days, and we're kind of pre-regulation in those spaces. So that I think it's not a panacea. It's not a cure-all at the moment. But I think from a potential point of view, both from a disclosures point of view and ultimately from a tradability point of view, you can see that the potential there. To me, it's like absolute prime tokenization use case, and one of the things that should be pushed forward, and that is beginning to happen globally. It's definitely on our roadmap. We are early stages of a partnership with GMEX on their 013 piece around how we can start offering offsets as well as the tokenized renewable energy certificates for businesses with more complex supply chains. At the moment, renewable energy certificates work really well for us because we're focused on companies, Bitcoin and other holdings. There's quite a lot of demand, I guess, because of people seeing the potential of this space. A number of our clients are asking us how we help them with a broader supply chain decarbonisation piece. And then often, because those are financial institutions, the conversation leads towards, and how would we trade these assets over time? So again, I think it's kind of, it's relatively small steps, but I think everybody can see that, we can all see the potential in the space. If I can just touch back on the previous point as well on the, on the governance piece. Again, one of the key things we were hearing at Sibos, and one of the key kind of convergence pieces that's driving maybe that governance conversation is the beginnings of some kind of consent. We hear a lot about competing jurisdictions, competing for talent, et cetera, in crypto, but actually the beginnings of a global consensus on regulation. And I think actually beginning to see an actual consensus being reached, probably out with the US at the moment, but globally we're starting to see a consensus being reached, which again is creating a comfort factor for larger organizations who need to kind of feel that level of kind of comfort and security. So yeah, I think that's the other, that's what we're seeing. Another key driver, again, it's one of this, if you've got this kind of list of reasons not to get into digital assets, complete lack of regulation and not knowing who the board is of a company that you're going to invest in, and there not being any transparency about where it's domiciled or who owns it, all of those things you start seeing to be addressed. And that is a kind of specific institutional concerns, because it may be that a retail customer doesn't care who the owner of a company is, but if you're the board of a large bank or a large asset manager, you definitely do, and you need to know that they take governance seriously, that they're not managing the company on a Google sheet and the money's disappearing out the back door somewhere. So all of these things are together. That's why we kind of talk about this kind of broader regulatory governance, sustainability, compliance, which is providing a kind of an equality. And Lena made the point very well. It's like, how do we apply some of those standards, but also don't lose the uniqueness of what we're doing and what of the uniqueness of the space. You know, the fact is we don't have a huge financed emissions footprint in our space. That's, you know, there's all sorts of unique advantages. So that's the balance, I think, for us as an industry. How do we leverage our USPs, but align with, you know, traditional TradFi standards so that people can actually understand what we're doing, which I think is kind of one of the key tenets of, you know, what's been holding, you know, the space back. And I think that's being addressed pretty well. A number of companies doing a brilliant job of that at the moment.
I think it's a great point, actually, and you bring up the regulatory clarity or almost a harmonization. We've seen specific digital asset policy coming out of the UAE, the UK, the EU. There have been mentions of ESG provisions involved in some of these, and I'd like to maybe open up this question to both Lena and Thomas. In terms of what you're seeing on the regulatory side, how important is it for ESG to actually be included in the conversation from the very outset? And based on the examples I provided or based on your research, are you seeing that this is being done sufficiently?
So what we are seeing is that ESG disclosure or ESG-related disclosure is already part of regulations also outside of the digital asset world. So we see this in a Corporate Sustainability Reporting Directive in the EU, and also in a Non-Financial Reporting Directive, and also the SEC is considering having more disclosures on sustainability-related aspects. And I think this is a great potential also to drive data availability and improve it over time, because projects and companies are already anticipating this this pressure and this need for data. So there we are already seeing some developments in this direction, and I think this will also hold true to the digital assets industry when regulation comes up. So we already see this now, for example, with the MiCA, where there are already sustainability disclosure mandates foreseen. So, for example, token issuers needs to disclose adverse impact and for the environment in their white papers, and at the same time also crypto asset service providers, which is really a range of players. So this would be custodian, exchanges, but also funds, and they also need to disclose adverse impacts in a prominent place on the website, like Mika says it. So we will still see how this play out exactly, but is going in this direction. And I think this will come more and more as soon as that regulation comes. ESG relevant aspects won't be overlooked anymore, so to say. And I think this could also be a great opportunity to have better data availability then build even better scores and dimensions, so to say, and then ultimately build enhanced trust towards these ratings.
Thomas, do you have any?
Yeah, I mean, we think this is probably the second step with ESG. So the first step would be if the SEC would finally allow the Bitcoin spot ETF, right? Also in Europe, we don't have ETFs yet, neither on, we have one, sorry, but there is none on a basket index, for example, that contains 20 coins or so. Also, what we currently see, what's out there is mainly products that are based on the top 15 coins. That's per the local exchange in the country that allows these products. So at first, I think we would need some general regulation how to launch traditional finance world products based on crypto, and then the next step would be ESG.
I think it's a nice consideration, and I do believe that once we have some more regulatory clarity and a better understanding of potential ESG provisions and policy, as you mentioned, Lena, will open up the potential for better data accuracy and availability. Hopefully it will be used as a catalyst by projects and within the industry to actually drive this initiative forward. Of course, the regulatory elements are going to be very vital for institutional adoption, for example, and I think by introducing these policies or these regulations, it will help to facilitate that institutional flow to the asset class, which I think is feels like it's on the cusp, but there are certain barriers that have been erected that are very difficult to break down. And as you mentioned, I believe a lot of the sentiment is quite positive in relation to the asset class, but there is still some work to be done to fully institutionalize it. So with that said, I think I'd like to maybe pose a question to the group. Looking ahead into the future, let's say 5 years from now, do we feel that the ESG component within digital assets is going to become a lot more relevant? Will it still hold its same cadence? Is the excitement still going to be there potentially? And more generally speaking, how do you see the space evolving looking forward based off of some of the ideas that you've mentioned in the panel?
So my perspective is that in like 5 or 10 years, ESG relevant aspects will be far less like a buzzword and a hype, but more like something which is just there and is considered along other criteria. So it will be much more common to look, for example, at the carbon intensity of an investment, or also to look at S&G relevant aspects. And I think this will become much more standardized over time, and then not be like something to be hyped on or to be against or in favor of, but it's just there and normal and will be integrated part of many other aspects which are also super important and shouldn't be overlooked to just look as ESG. So it's like in the basket of all relevant things, this will be one, and this won't be like the outsider anymore, but more like a institutionalized and more integrated part.
Yeah, 100%. I mean, I think absolutely, if this is just like a hygiene factor that we're not really having to talk about, that is a standard part of assessing what digital assets you would buy into, I think that the industry would have done a really great job. I actually think, the last 2 years have seen a massive move forward. When we started looking at this, it was really, very, very, very nascent, I would say, and pretty much being ignored, I think, because where we were from a market point of view. I actually think probably one of the advantages of a slower retail market is a chance for a bit of introspection and a chance to align, with some more real world good or bad. And I think that's actually been one of the positives. So yeah, for it to be kind of hygiene factor, not to be a hype thing, for us to be well past any kind of greenwashing applications, and then hopefully for tokenization to have revolutionized those kind of carbon markets and making those really robust, tradable, trustable, all those things that we hope they will be.
Yeah, at MarketVector, we believe that crypto will be considered as an asset class like any other. So there is the demand for ESG. We see a lot of that. And of course, we also see the respective regulation, especially in Europe. So regarding reporting, also regarding the ESG stamp on products. So yeah, if we say there will be similar, or the market environment will be similar to equity and fixed income, then yes, of course, there will be much more ESG in 5 to 10 years.
That was a really insightful panel. I think maybe I'd like to just wrap it up with a couple of thoughts. I mean, it is clear that the institutionalization of cryptocurrency is occurring. I think we've mentioned some of the barriers that exist. Clearly, CCData, CCRI, Zumo, MarketVector, we're all key players in trying to push the initiative of ESG, or at least try to highlight the issue quite extensively. From CCData's perspective, we've published a benchmark methodology which looks at assessing a top 40 asset universe amongst both ES and G factors. A lot of great work has been done by the rest of our panelists here in trying to further these initiatives. And as you mentioned, hopefully ESG actually becomes a bit more of a boring conversation, because clearly there's a lot of hype, but with that hype comes a lot of building blocks to come along. So hopefully in 5 years' time, we do see a lot more introspection in relation to the ESG factors, and hopefully we can turn it from a clear deterrent from the media into something a lot more positive that we can use to push the space forward. So with that, I would like to end the panel here. So I hope everybody had a really insightful and interesting discussion, and I thank you all for your time and for being here. And if you do have any other questions, obviously feel free to stop myself or our panelists afterwards, and we're happy to answer any additional questions. So Thank you so much for your time, and thank you all as well.
Thank you.